Hi everyone, welcome to our webinar on the Forex outlook for Q2 of 2020. I'm Ming Hui from Phillip Futures, and speaking to us today will be our investment analyst, Samuel Siu. Before we have Samuel up, I'd just like to inform you that should you have any questions throughout the course of this webinar, please feel free to drop them into the questions box because we will have a Q&A session towards the end of the webinar. And now, without further ado, let's have Samuel up on air.
Thank you, Ming Hui. A very good evening to everybody. Can you all hear me? If you can, please indicate in the question box, and then after that we can proceed from there. All right, so understand that most of you are working from home at the moment due to the circuit breaker in Singapore. So I'll try to liven up the seminar to make it more relatable to your day-to-day life. All right, so a little bit about myself. Before I begin this seminar, just a sole disclaimer, this is solely for education purpose only and does not constitute to any form of financial advice. All right, so a little bit about myself. I'm Samuel. I'm an investment analyst with Phillip Futures. All right, I specialize in the Forex indices as well as the equity indices. So on a day-to-day, what I actually do is I do provide daily commentaries to clients. All right, and then you may have seen me on the media before or maybe have attended some of my seminars in the past. All right, so today's seminar will be quite lighthearted. All right, you will first start off with a little bit of introduction to Forex because I understand that not many of you have traded Forex before. So this will give you a little bit of the fundamental knowledge on how to trade Forex, what is Forex about, etc. After which we'll move on to the currency outlook of the second quarter of this year and a slight introduction to our MT5 platform and how it can help you with your trading activities. So even though right now we have the circuit breaker, I'm sure that prior to this lockdown or circuit breaker per se, many of us have actually traveled overseas or actually buy things online. So when we are actually doing all of this, what we are actually doing is we're actually exposed to Forex itself. Because what Forex essentially is the changing of one currency to another currency. Except we are putting it right now into a bigger context because, like example, when we go overseas and most we are changing a few $1,000s, but when we are actually trading Forex, what we are dealing with is tens of thousands of dollars or even, in fact, $100,000. So because of this, a slight movement in the exchange rate will actually attribute to profits or loss for us when we are doing Forex trading itself. So it's very simple. It's actually a marketplace that brings traders together for them to exchange currencies. So when one person wants to change currencies with the other, they fix a rate and the currencies are exchanged at that fixed rate. So this is essentially what Forex trading is. And we all know that for Forex trading, we are always essentially basing one pair against another pair, meaning to say that we are always basing one currency against another currency. In stocks or in fact in indices per se, you are only basing on the particular product itself. But for Forex, we are doing a comparison because what we are essentially doing is trading one currency pair with the other. So like example, if we are looking at the USD JPY pair, what we are essentially doing is we are changing yen for the US dollar. And if like example, we are using the USD SGD pair, we are changing Sing dollar for the US dollar. So that is how we actually identify Forex. And when we are comparing Forex pairs per se, we are using the various currencies by comparing the strength against each other. So like example, if let's say the Sing dollar strengthens more against the US dollar but weakens against the yen, all right, we can see that in the US SGD pair, it will strengthen, all right, but you will see that the USD SGD will be weakened and the US and the SGD JPY will weaken as well because we are looking at the yen is strengthening faster than the Singapore dollar. So we are looking at comparison between currency A versus currency B. It's not so much on if currency A strengthens, it's going to strengthen against every single currency. So we are always looking at a comparison for Forex trading. Okay, so when we are buying or selling, we are essentially referring to the base currency. So for example, if we are looking at the EUR USD pair, when we say buy this pair, we are essentially buying the EUR and selling the USD. Okay, and it takes place concurrently. So if we are looking at a SGD JPY pair, when we are saying we are buying, we're actually buying the Sing dollar, selling the yen. All right. So what does this essentially mean when we see a EUR USD price like that? All right, the prices now is very different. All right, it's no longer at such a high price, it's slightly lower. But what it essentially means is that you will be paying 1.22417 USD per euro. So like just now stated, if like example you are buying the EUR USD, all right, you will be hoping that the euro strengthen against the US dollars. All right, then we will be looking at how is it quoted. I mean, usually when people are going to the money changer, etc., it's only quoted in 2 decimal places, right? But right now, if you are doing forex trading, the more decimal places there are, the more beneficial it is for you. Why? It's because it's more accurate to the market price, and of which when you open and close positions, the spreads are also lower because there is more denominations for it to pair against. All right, so for forex trading, when we are looking at significant profits or gains, we will be looking at 1 pip. Okay, so 1 pip, essentially, if you are comparing it in the 1 lot size, because 1 lot is $100,000 worth, 1 pip will be approximately $10. Okay, so of which this will be the significant profit or loss to yourself. Of course, at Phillip Futures, we do offer smaller lot size. So if, like example, you are trading the mini, which is 10,000, all right, 1 pip will be $1. If you are trading the micro, all right, 1 pip is 10 cents. In Phillip, we actually offer you fractional pips as well. So what does these fractional pips are? Is actually the one more denomination as compared to the pips. And what happens is that it is essentially making your spreads tighter. Because when you're looking at MT5 itself, things are quoted in fractional pips. So if, like example, you are looking that, hey, you are seeing that the spread difference is 6, what essentially means is 0.6 pips. So if it's 0.6 pips, it's essentially very tight spread, and it's good for the investors, because if you buy and sell instantaneously, you only lose 0.6 pips, which is not even a significant 1 pip. So this is the first expense that people will incur when they are actually buying or selling currency pairs, or we call it forex trading. Because forex trading at Phillip is actually 0 commission. So what essentially is the cost to consumers is the spread. The tighter the spread, the lesser the consumers are paying for, because if you buy and sell instantaneously, you only lose the spread. Okay, so this is that per se. And if you want to buy immediately, you will be looking at the offered price. If you want to sell immediately, you'll be looking at the bid price. So if the spread is tighter, beneficial for you. If you are trading at weirder hours, the spread may widen a bit, then it may not be so good for consumers itself. So when we're looking at the presentation of currency pairs, we must always look that currency pairs are differentiated to many different kinds. So if you are new to it, maybe you would like to focus on the G7 pairs, because these are the more commonly traded currency pairs. The spreads are usually tighter, higher liquidity, and there's the most trading activity. So if you're looking at other exotic pairs, like maybe some people want to trade the GBP JPY, for example, yes, they are available for trading. What happens is that there will be lesser liquidity, and you can see that the spreads may not be that tight. So why do we trade forex? First thing first, forex is an extremely liquid market. So what happens is that, unlike maybe the stock markets per se, whereby some stocks there may be a majority shareholder, etc., forex markets is so liquid such that there's no single entity that can manipulate the forex markets, and there will always be buyers and sellers because it's a global market, meaning to say that around the clock there will be people trading, because not only are retailers or retail investors like us in the markets, the corporates, etc., when they're doing hedges, they're also in the markets, and it's the same forex market as well. So some people may ask, so who is the one that can move forex markets? And the answer is actually the government itself. So like example, when President Trump speaks, etc., he do carry some weight, and he will move the US dollar accordingly. So why do we trade forex? Because forex is essentially bi-directional. You can long and you can short. So you can always profit from either market directions. There's also around the clock trading. You do not have to worry that there is a particular hour that you cannot trade at because it's traded 5 days a week, 24 hours a day. So for Forex itself, there's something called leverage. Leverage is essentially margin trading, and what it means is that you will be able to amplify both your returns and losses. So you are putting a capital outlay of the sum to trade a larger contract. For MT5 Forex trading with Phillip Futures, what happens is that the leverage is approximately 20 times. So if you put in $5,000, you can trade up to 100,000 worth. All right, that is the initial margin. All right, so if you want to trade in smaller sizes, it will be accordingly, meaning a mini lot to open, it will be $500. All right, for a micro lot is $50. So with that in mind, all right, you will be able to free up your capital for other investments. So the value of one micro lot, if you are new to investing, is actually $1,000 worth. You are only needed to come up with an initial sort of like margin of $50, and your profit and loss will be small, but because of that, there's no commission charges at all, zero comms, so you can actually use it to trial. Because the profit and loss may be minimal if you are trading in small quantities, all right, you can use it to trial and to practice your trading strategies, get familiar with the markets, then subsequently scale up your positions. This is what many beginners actually do, because the best way to learn from the markets is actually to be in the markets itself. The rest are all just mere theory, and they may not be applicable on a day-to-day basis also. So that's what many traders actually start off with. They start off small. Once they are confident in their trading strategies, then they scale up their positions accordingly. It's low cost. There's no zero commission. So unlike maybe stock trading, etc., where there's a minimum commission, right? For futures trading, there is zero commission. You can buy and sell how many times you like, all right? And there's no cost to you at all in terms of commission. There's also micro lots available. So without a minimum commission, you can trade micro lots. The position size is small, but you can use it to trade. Then once you are very comfortable, then you slowly scale up your positions. All right. So one thing to note is that something called swap points when you're doing Forex trading. This is the second expense that people have to be wary of. Why? Because if you hold a position past 5 a.m. Singapore time, all right, depending on the daylight savings, right now it's 5 a.m. So if you carry it over 5 a.m. Singapore time, essentially you will be paying or receiving something as what we call swaps. What is swaps? Swaps is essentially the interest rate difference between two currencies. Because when you are essentially trading a currency, as I explained just now, for example, if you are buying USD and selling Sing dollars, what essentially you are doing behind the scenes is you are borrowing from a Singapore bank Sing dollars, all right, and then after changing it to US dollars and putting the US dollars in the US bank itself. So we all know that between different banks, there are different interest rates. So like example, if the Sing dollar is sort of like Singapore banks are giving you a low interest rate and the US banks are giving you a high interest rate, essentially what happens is you will gain this swap points. All right. If like example, the reverse is true, then you will be paying the swap points. If both sort of like interest rate are very similar, you also will be paying swap points. Okay, so this is something to note. So if people they do not want to pay the swap points, what they essentially do is they do day trading and they do not hold overnight positions. So there's also a trading strategy called carry trade. What some people also do is they buy a currency which give high interest rate and sell a currency which give low interest rates, and they earn the carry charges. All right, this was very popular in the past. One of the more popular currency carry trade is the USD JPY pair. However, ever since the Fed slashed rates 2 consecutive times, and right now it's close to zero due to COVID-19, we can see that this carry trade no longer is very valid, and people actually unwind their position. So right now, most interest rates are quite similar because a lot of central banks have slashed their interest rates due to COVID-19, and because of that, we do note that you would have to pay closer attention in terms of swaps. So an example will be as followed. If, like example, the US did not slash rates and it's still at 2% per annum, when the Japanese yen is giving at minus 0.1% per annum, if you hold it for a year, essentially you are getting 2.1% per annum due to this carry trade. So why do we trade Forex? Very simple. First thing is it's bi-directional. You can long and can short. All right. Second thing is trading 24 hours around the clock. There's leverage. So you're actually putting a small capital outlay. It's low cost because it's zero commission. And there's something called swap points which you can earn if you are doing a carry trade. So before we begin the outlook, I would like to share some important fundamentals with people who may be new to Forex trading. It's known as the various terms that people use when doing Forex trading. First thing is something called safe haven currencies. Safe haven currencies right now is very relevant in our current time because we are experiencing a crisis known as COVID-19. So with that in mind, people are more risk averse, and when they are more risk averse, they'll tend to look at safe haven currencies, and this is something that is gaining strength of late. So if we're looking at the US dollar is one of the safe haven currencies. It's known as the world's reserve currency because a lot of the corporate loans, etc., are all denominated in US dollars. Trading wise, in terms of global trade, is also done in US dollars. For the Japanese yen, is the world's biggest funding currency, all right, and then it's in comparison to the US, is second in line because aside from US dollar trading, in terms of global trade, people also have some contracts denominated in yen. All right, and then you're looking at other safe haven currencies, including the Swiss franc, which is has low national debt, etc. And so that's why it's the healthiest country in the Europe and is used as one of the benchmark for safe haven currencies. For the Sing dollar, it's deemed as a safe haven currency in the ASEAN aspect because our currency tends to be more stable, as well as political wise, we are also slightly more stable as well. So when markets are selling off assets, usually they will tend to keep the funds in the currency that they are borrowed so as to avoid loss in currency fluctuations, and with more stable assets like maybe in the US dollars, etc. So when they sell, they'll keep in US dollars, and you tend to see that the US dollar will strengthen from there. So with right now, if you notice that there are assets liquidations because people feel that cash is king due to the current uncertainty, you can see that because of that, the US dollar have gained some strength accordingly. So aside from that, we are also looking at commodities related currencies. All right. So for commodities related currencies, people will be looking at things that currencies that rely closely on the country that rely closely on commodities trading, and that's why their currencies are very closely related to the commodities prices as well. All right, these currencies tend to be for people who are more risk loving, and when you can see that when markets are in a better state, usually this kind of commodities related currency will strengthen accordingly. So for Australian dollars, it's quite related to the hard metals because the mining industry over there is still very strong. So therefore, you can see that it's more correlated to hard metals like iron ore, coal, etc. For the New Zealand, it's soft commodities, all right, because they are very strong in the agricultural business. So we can see like milk, agricultural products, grains, etc. They tend to be New Zealand dollar tend to follow these commodities more closely. And for Canada, because Canada exports crude oil a lot, it's one of the major exporters of crude oil. So because of that, we can see that for the Canadian dollar itself, it's usually quite correlated to crude oil prices. Okay, so when the economy is good, the demand for these currencies will grow as investors expect more demand for raw materials, and therefore it will strengthen in a better economic environment. So how to trade Forex? Well, to trade Forex, we essentially look at the news and data because, like example, when people are trading stocks, they'll tend to see how the stock is performing in terms of the company. So when you're trading Forex, what Forex essentially is they are talking about various countries' currencies, and currencies, how is it based on? It's based on the country's economic strength. So when the economy of the country is doing well, all right, you can see that the currencies will strengthen accordingly as well. So some of the important data we look at will include the non-farm payroll numbers, GDP numbers, retail sales numbers, etc. Of course, central banks' decisions are very, very important in terms of currency strength as well, because central banks do decide the monetary policies for these various countries. So we must understand first thing that central banks decide is interest rate. Currencies tend to do better in a high interest rate environment. Okay, why is that so? It's because if, like example, today, if I'm telling you, let's say the US is giving you an interest rate of 5%, and if Singapore is giving you an interest rate of 0.1%, will you put your money in the US bank? All right, most people will, because they are thinking that putting it in the bank is risk-free, and putting it in the US bank, if I'm getting 5%, all right, is definitely much better than getting 0.1% maybe in Singapore. All right, this is using an assumption. All right, so with that, if that's the case, what happens is that people will change Sing dollars to US dollars to put it in the US bank because they want to gain this risk-free interest rate, and because of that, the higher demand for the currency will cause the currency to strengthen accordingly. And that's why people do pay very close attention to central bank decisions, because when central banks decrease interest rate, it will cause the currency to weaken, and when they increase their interest rates, it will cause the currency to strengthen accordingly. Of course, the central bank do decide on monetary policies as well, things like quantitative easing. So if, like example, they do have quantitative easing, etc., it's going to cause more supply of the currency in the market, and because of that, it's going to cause the currency to weaken. So because of that, central bank decisions are very important, and people do look out for the central bank meetings for currency direction. All right, and we also look at geopolitical news is important as well. Things like war, natural disasters, political unrest, elections, etc., because this will dictate the currency strength as well. So if the currency is at war, obviously their economy will have some form of headwinds, and because of that, the currency will tend to weaken. All right, same for natural disasters, because the government will have to incur a greater fiscal budget to actually repair the economy due to these natural disasters. And so for political unrest, we can see it very prominently in the Brexit incident that happened throughout the past few years, whereby there was so much uncertainty due to Brexit, and because of this political unrest, all right, it actually resulted in the pound dipping quite a bit. All right, and then right now, because we are seeing COVID-19 engulfing the entire globe, we see it that investors are more risk averse right now as well, and they tend and you see it reflected in the currency movements as well. So when we are trading forex, we actually have two major approaches that usually people do, even for stock markets, etc. First is the fundamental analysis, and next is the technical analysis. So for the fundamental analysis, we are using the macroeconomic factors to actually decide how the markets are going to go, or the direction markets are going to head towards. While technical analysis, we are using historic price data to actually form a pattern or trend and analyze from there. So today, we actually be focusing more on the fundamental analysis part, because we will be looking at the fundamental aspect of the various countries' economy, and after that, we'll be deciding how we can proceed from there. So for the seminar outline, all right, I'll be actually covering four main currencies today. All right, this US dollar, the British pound, all right, the euro, as well as the Australian dollar, because I think that is something people are more interested in. All right, I will not be covering the Singapore dollar, but if you have doubts on the Singapore dollar, you could ask me during the Q&A later, no issues. All right, so for the US dollar, we note that the US dollar has actually strengthened in the first quarter. All right, but if you look at this when comparing to the yen, it paints a slightly different picture, and is slightly on the downside. Is because the yen actually strengthened as much as the US dollar as well. In fact, more than the US dollars, because what happened on the yen side is the Bank of Japan is right now the only central bank, all right, one of the only central banks that have yet to reduce monetary policies. They kept their monetary policy stagnant, and because of that, its status as a safe haven currency has also caused the yen to strengthen quite a bit. And because of that, you can see that the yen strengthening faster than the US dollars. But if we use the US dollar comparing to other currencies, and if we compare to the Sing dollar, for example, you can see that the US dollar have strengthened greatly against the Sing dollar. All right, it has strengthened around 5.85%. So because of that, we note that actually the US dollar strength is still there. What are some of the reasons why the US dollar strengthened? Is because of essentially COVID-19. All right, the strengthening of the US dollar is because right now with COVID-19 in play, people are more fearful. Right, when people are more fearful, they look at safe haven currencies, and because of that, the US dollar also gained some shine. However, why it paled in comparison to other safe haven currencies like the yen is because of the Fed itself. The Fed have actually struck measures to try to mitigate the effect on the US economy itself, and because of that, it has caused the US dollar to weaken. All right, so I'm going to explain. First thing first is that the Fed had two unexpected rate cuts. All right, this was not done during the regular FOMC meeting, and what happens is that when they had the rate cuts, it was so sudden, it resulted in more fear in people. Because usually when there's a rate cut, if it's a gradual rate cut, people usually will see it as it in place to support the economy. But the Fed's rate cut was slightly quite sharp, and within two rate cuts, it slashed its interest rate from 1.5% to close to 0% right now. So because of that, markets had more fear, and it resulted in the dollar dropping quite a bit. All right. Second thing is the quantitative easing measures by the Fed. We shall go in depth soon. So we can see that when the Fed raised interest rates, they raised it gradually. So it was over a period of 3 to 4 years. They started in 2015. All right. However, when interest rates are reduced due to COVID-19, it was instantly reduced over a span of 1 month. The spread was just 2 weeks apart from each other. From 1.5%, it reduced right now to close to 0%. So because of that, this shock in lowered interest rate actually resulted in the dollar to lose strength. So we can see that it's two drastic dips. Next, we notice that there are QE measures by the Fed as well. So what happens is that when we're talking about quantitative easing, essentially it means that the Fed is printing money. But when the Fed is printing money, they don't print money and just flood the market. They have to do something with it for it to have a multiplier effect. So to support the economy, the Fed actually started QE once again. But what happens is that it pledged asset purchases with no limit. So if we look at the past QE measures, usually they will have a fixed budget or a fixed amount that they will go into the markets to buy treasury bonds every month, so as to flood the market with money. But right now they are pledging asset purchases with no limit. So because of that, with a higher supply of money in the market, it actually caused the dollar to shred away some strength. In addition, it also launched an additional 2.3 trillion US dollars in terms of monetary stimulus aimed at the small medium enterprise by giving them loans that are close to 0%. All right, and by not wanting payment from them for the next 1 or 2 years to help them get by. So because of that, this will also weaken the currency's economic standing, because you are printing money to loan to these people with no returns. All right. Lastly, something that shocked markets is that the Fed actually pledged to buy corporate bonds for the first time in history. So last time when the Feds are doing QE and when they are rebuying assets, they're actually buying US Treasury notes. So this will actually stabilize the economy, etc. But right now, because of COVID-19, they would like to support the various companies as well. So they have plans to buy corporate bonds. They did state that they will buy the higher grade investment grade corporate bonds first. But that being said, it still means that there is higher risk. And because of that, it caused markets to feel more jitters. However, going forward, we still feel that the US strength will sustain because cash remains king. What happens right now is that we must understand that all assets are having huge volatility. So usually in this kind of volatile markets, people tend to be more risk averse and tend to look for safe haven currencies, of which the dollar tend to shine. Why is that so? It's because the dollar is the world's reserve currency as well, and it's the funding currency for many corporate loans. So what happens is that corporates, etc., they tend to hoard cash because they are unable to predict their future cash flows. So in order to maintain a healthy books and everything like that, so as to prevent themselves from going into bankruptcy, etc., some of them tend to hold cash so that they are able to make the payments. And if you're looking globally in terms of retail investors wise, people also tend to hold cash because they do not know what to invest in right now due to the volatility, and because of that, it actually caused the US dollar strength to rise further. And we note that the US dollar funding squeeze is still present despite all the liquidity measures by the Fed by actually providing more supply of the US dollars in the market. We note that there is still a squeeze in the sense that there's still a huge increase in US dollar demand, and this actually caused the squeeze, and that's why the Fed is constantly trying to come up with measures to actually ensure that there's sufficient liquidity in terms of cash supply in the market. All right, so we note that the US dollar will be driven by the broader risk sentiments and tend to be performing in tandem with the risk sentiments itself. So like example, if you see that COVID-19 is becoming worse, all right, whereby you can see that there are more cases erupting and you possibly extending of COVID-19 globally, we note that the US dollar would tend to strengthen further because of that. Also, we note that the US economy is actually not doing that fantastic as well. If you look at the latest US numbers, it's also quite bad. But because of that, ironically, because the US economy is doing quite poorly, it actually stimulates more fears that the other economies are going to do equally or even worse off than the US economy. And because of that, it actually caused a flight towards safety and people investing in the US dollars more, or actually holding the US dollars more. So with that in mind, the US dollar, as long as COVID-19 still persists, there's no like possible end to COVID-19, you can see that the dollar strength will still be there, and people will tend to favor the dollar because it's more stable as compared to other currencies due to its status as the world's reserve currency. So if we look at the US numbers, we can see that US numbers are already starting to feel the impact of COVID-19. Yesterday, we did see that in terms of corporate earnings wise, most corporate earnings showed downbeat results, and we can see that the US banks actually raising concerns that retailers or consumers may default on their loans because they may not be able to pay due to COVID-19. And when we look at the economic front, the manufacturing numbers in the US have been slipping since February as well, because in February itself, towards the end of Feb, COVID-19 starts spreading in the Europe side as well as the US side already. And March itself, even worse because the spread start to spread, and because of that, we can see lockdowns in US happening in mid-March itself. In terms of the service PMI, since January itself, it has been in contraction because what happens is that tourism's numbers started dropping, etc., because people tend to be more fearful and started avoiding travels because of COVID-19, etc. And we can see this is a very significant number that people look at. You look at the sudden spike from March onwards. This is what we call as jobless claims, because in US, they have this pension system whereby if you are jobless, you can claim money from the government. So what will happen is that it shows that the number of jobless people have instantly increased overnight due to COVID-19, because corporates are more prudent. They start to trim their staff, and because of that, the jobless numbers rose. The last time jobless numbers rose was actually in so greatly was actually in the 2007 financial crisis. But what happens right now is that the numbers we are seeing is actually dwarfing what we saw in 2008, and because of that, people are more fearful that so long as COVID-19 persists, there's no new cure to COVID-19 as it's a medical disaster. So what happens is that the main way to resolve this medical disaster is the development of a vaccine or a cure. If that failed to happen or prolonged period of time is taken for that, the only way is to control the spread. And by controlling the spread, huge economic damage will be seen as what we are observing right now. And because of that, the dollar may still tend to show some strength going forth. So we are looking at the forecast and we are comparing the US dollar to the yen. We notice that the US dollar right now is showing some consolidation, all right? The moving averages have flattened, and because of that, once the dollar actually passed the moving averages, it's likely to strengthen further. So if we are looking at the pivot points which are available on MT5, all right, you can see that these are the few support resistance which we can look at. All right, in MT5 as well, we have something called the Trading Central, and the Trading Central do give analyst views from the Trading Central itself. So because of that, you can see that instantly you will know or you will be having resources to tell you what to do: buy, sell, or do nothing. So right now, if you can see that the Trading Central preference right now is still of a buy position, and it still feels that there's upside potential for the US dollar and yen. So next, we'll be talking about the pound. I'm sure some of the people will be interested in the pound because the pound had actually very interesting year last year, and this year itself, we all know that Brexit actually happened after so long. But yet, that being said, the pound actually dipped 5% again, 5.6% against the US dollars. All right, what's the rationale why? It's because firstly, despite successfully pulling out of the EU, it's just the start of the problem, because by pulling out of the EU, essentially there's more uncertainties brought about to the UK itself. First thing, it has to settle a lot of its trade agreements. All right, the trade agreements, even though some nations have agreed to remain status quo as per what it was with the EU, but definitely the EU and the UK will have to strike a new trade agreement, because right now free trade cannot carry on due to the UK leaving the European Union. So because of that, they had drastic differences on striking the trade agreement, and it's going to bring about more uncertainty. Also, the deadline is actually set for the end of the year, and right now with the emergence of COVID-19, I mean, as it actually adds more difficulty to the equation, because there's much more things to worry about in terms of the Prime Minister's decision. All right. Second thing is it started to forge trade deals with other nations. So it, prior to COVID-19, you can see that the foreign minister of UK actually going to Japan, Singapore, Australia, etc. to try to strike trade deals, but there were limited results seen. And right now with COVID-19, there's practically not much development on that space. So because of that, it brings about more anxiety to what to expect next going forth. Also, we notice that the BOE has actually slashed rates drastically. Right now it's 0.1%, and it's ramped up its bond buying program, essentially QE, because this is done to support the measures in place in terms of the UK economy because of the COVID-19 weakness. But because of Brexit and everything as well, we can see that corporates right now have lower confidence in investing in the UK, etc. And because of that, some of them have pulled out. And with COVID-19 in place, we can see that the UK is in for a very tough year. So we are of the view that the pound has really much more downside risk ahead, because it's actually facing a double whammy. The double whammy arises from both Brexit, whereby the uncertainty is still there, and COVID-19 itself. So the UK's economic data appears to be in doldrums. Technically, if you look at its GDP numbers, its manufacturing numbers, business confidence numbers, etc., it's showing that it's actually shrinking at a faster rate than the 2008 financial crisis. So because of that, people are very, very worried that the UK economy may not be sustainable, especially if a hard Brexit really occurs at the end of the year. Because we have to note that if the UK and EU do not strike a trade agreement by the end of the year, what essentially happens will still be a hard Brexit, whereby the borders between both countries will still be closed, and in fact trading, etc., will become an issue. All right. Next, we are looking at COVID-19 itself. COVID-19 has caused much more uncertainties to the UK economy. The UK actually started off using the measure or adopting the measure of herd immunity. So they did not lock down fast enough, but subsequently they locked down. So by locking down, we can see that the situation in UK is still quite bad. Death numbers in the UK are still rising rapidly, even as of today, and is putting a strain on the healthcare system. So because of that, the second quarter of the UK economy is going to get worse because of the COVID-19 induced shutdown. And we can see that there was a scare a few weeks back as well, all right, due to the Prime Minister being warded into intensive care, as there's no succession plan in the UK government right now just yet. So when he was in intensive care, it actually caused more uncertainty in the pound itself because they do not know what to expect. So in short, having left the UK earlier this year, left the EU earlier this year, the UK itself have plenty on its plate to actually resolve. So the COVID-19 side will actually delay the country's ability to resolve these outstanding issues and cause more strain on the pound going forth. So if we look at the GDP numbers, right, for the UK itself, one very unique thing about them is they do issue month-on-month GDP numbers release. So if we look, right, that this year itself, the month-on-month has actually been decreasing, and prior to that, the numbers have not been very fantastic either because there were more decreased month-on-month. So going forth with COVID-19 in place, predictions as well as forecasts are showing that it's going to be worse. And if the month-on-month GDP decreases are getting larger and larger, it's going to put a huge strain on the UK economy. So if we look at the forecast itself, even though the UK actually found, the pound actually found some reprieve this few days, we note that selling pressure is still strong, all right? It failed to break above the 200 EMA, all right? So right now it's just broken below the 50 EMA again, and there may be more downside risks ahead. So if we look at the MT5 trading central preference, this trading central indicator is available at Phillip Futures if you open an account with us, free of charge. And so you can see that right now they are still on a decline preference as well, and they feel that the target price is much lower, and maybe it can even go back down to the 1.16 levels, right? So how about Europe? Europe itself, even though the economy structure is quite closely linked to the UK itself, but after Brexit, they tend to stand on its own economy, and because of this, it's quite messy in the EU itself because of all the various member states, and this may cause some strain on the euro going forth. So if we look at the euro did not decline that badly against the US dollar as compared to the pound or even the Sing dollars, but it still fell around 2.75%. Okay, this was mainly due to the slowdown in economic numbers. All right, main thing is that the Europe economy has not been faring very well since 2019. All right, so we can see that manufacturing numbers in terms of the Eurozone and Germany itself have all been contracting since February last year. With so many months of contraction, it shows how much strain is actually caused the European economy. And because of COVID-19, even though the ECB is actually already at 0% interest rates and etc. kind of thing, it actually restarted QE in huge demand because it wanted to actually sustain the European economy. So when your economy is not faring that well and met with additional disasters, all right, it's going to put further strain on the outlook as well as the strength of euro itself. Also, one thing to note is that Brexit happened and UK was the biggest financial center of the EU. So with the loss of UK, all right, the EU right now has to actually scramble to find measures to actually sort of like fill the gap left by the UK in terms of the budgeting, etc. And most EU nations in terms of financial standings are not that fantastic, as we can see from Italy last year itself, whereby the debt crisis, etc., put huge strain on the euro and whatnot. So because of that, we can see that the economic structure and stability of the eurozone right now is still something to watch out. So if we see in terms of the PMI numbers itself, we note that there has been a huge decline in terms of manufacturing and right now servicing as well. So you can see that it has been in contraction, and this is really very worrying. So more downside risks actually are ahead for the euro because it's still trying to maintain its economic footing, as the economic situation in the EU does not look optimistic already. So with the backdrop of Brexit and COVID-19, it's going to look even more ugly. All right. Recently, we see that the EU ministers have finally reached an agreement to mitigate the economic impact of COVID-19. However, one thing to note is that the process was very tiresome. All right, it was very difficult, and the negotiation process broke down a few times before eventually achieving a last-hour deal. So with that in mind, you note that actually right now there's a lot of disagreement financially in the EU itself, and the finance ministers of the EU, if in fact have some open quarrels with the ECB chairman Lagarde this year as well. So it shows that there's many unhappiness, a lot of uncertainty because they cannot agree on things. And this is the unique structure of the EU, because all member states have to agree on certain things before it can pass. And with that in mind, it shows that more time or potential delays could actually happen as well if the opinions differ drastically. One more thing to note, even though it's no longer on the news, but EU-US relations are still hanging on the line. All right. The US have stated they are going to go after the EU next, all right, in terms of trade agreements, etc., kind of thing, and both sides have yet to come up with an agreement. All right. If the UK eventually put automobile tariffs or things like that on the EU, is going to weaken the EU economy even further. And right now, to make matters worse, research is showing that the emergence of the US COVID-19 cases actually started from the EU itself. So because of that, we are not sure how is it going forth, and EU-US relations will be very, very crucial. So if we're looking at the forecast itself, you see that it failed to break above the 50 exponential moving average, and since then it shows some decline. All right, more weakness may be ahead. And in fact, if we're looking at the forecast itself based on Trading Central, it's also showing that it's a decline. So the last market we are covering is actually the Australia market. And Australia market itself, we can see that it actually weakened close to 10% against the US dollar. All right, why is that so? And why is the Australian dollar poised for more weakness? We must understand that in the first quarter itself, what happens is that the BOA actually cut rates again. So right now, interest rates are at all-time low for the Australian dollars, close to zero as well. Australian dollar used to be strong because of its high interest rate environment, and it attracted a lot of foreign funds. But right now, with that in mind, and you're looking at the Australian economy, people are very worried. It's poised for more weakness because the rating agency S&P actually downgraded the country's credit rating from stable to negative. And why is that so? It's because of the borrowings. All right. The Australia is already in a weakened debt position due to its QE measures. All right. And there's more stimulus plan ongoing, and of which many of it will be borrowed, because unlike Singapore, Australia does not have a strong reserve. So because of that in mind, it's going to further weaken the credit ratings, and people are more worried about the Australian dollar strength going forth. Also, prior to COVID-19, Australia barely scraped by a national emergency. This was known as the bushfires. The bushfires started from the start of this year in January itself. So it caused a lot of economic damage, all right? It caused tourists to avoid going to Australia, and it dampened their growth cycle. And because of that, with them yet to recover from that crisis, immediately COVID-19 struck. Their tourism do not even have time to pick up, and then people actually stop traveling to the Australia already. Even though we see that in terms of the employment side today, there was some positivity in the numbers, but that being said, is because the numbers do not include what happened in the later part of March itself, where there was a COVID-19 induced shutdown in Australia. So because of that, it may not be accurate of the actual situation ongoing there right now, and it's most likely going to falter in the subsequent months. So because of that, there's still much more downside risk ahead for the Aussie dollar. All right. Also, we note that the COVID-19 struck Australia with such a severe economic and fiscal shock that the Australia's economy is expected to contract 10%, right? Its steepest and deepest possible recession in 90 years. So with that in mind, people are still very worried about the Aussie dollars going forth as well. Even though the trading central side is posing to a potential buy, whereby they feel that there's still upside potential maybe to reach back the 0.66 levels, we are still quite bearish on it because fundamental wise, there isn't much reason for the Australian dollar to strengthen further. So with that, we have come to one part, which is the end part of the sort of like the outlook in terms of currency outlook, and we'll be focusing on what the products Phillip Futures actually offer. So that being said, Phillip Futures, we actually have spot bullion trading, and you can trade over 40 currency pairs available for trading using our MT5 platform. So our MT5 platform, zero commission, you can trade micro lots, etc. Okay, we also have different tools available like Trading Central, which you have seen just now. It shows you the analyst views. Also, it can show you candlestick patterns to tell you whether there's a reversal pattern, etc. There's also Auto Chartist. Auto Chartist enables you to scan through all your currency pairs in your watchlist itself to see which patterns are actually forming and tell you to buy, sell, or do nothing. So it's something like this. You can see that it scan through, tell you what are the patterns, tell you the target price, all right, in terms of the gray area here, and tell you what the support and resistance. So they do a projection for you as well. All right. So Auto Chartist is also available on your mobile, everything. And once you have the live platform, you can have the Auto Chartist mobile. So some of the things or the benefits of MT5 is a multi-asset platform. Why multi-asset? Aside from trading currency pairs on MT5, you can trade gold, silver, oil, and even indices on MT5 itself as well. It's a multi-strategy platform because you can buy, sell, you can do hedge, etc. There are various graphic tools available, like the various indicators, RSI, average true range, moving averages, etc. all available. You have the news and calendar option in one window. So if you are interested to see what are the news happening or what are the economic events happening, you can just do one click and you can see everything in your MT5 platform itself. So it's very easy. Hedge and net mode, you are able to have a concurrent buy and sell position of the same currency pair to hedge your positions. All right. There are automatic trading tools available. This is available on the marketplace on MT5, and if you are interested, you can explore it. All right. There's zero commission on MT5 itself, and the spreads are very, very tight. Also, you can trade in varying sizes. Like stated, you can trade the full lot at 100,000 worth. All right, you can trade the mini lot at $10,000 worth and the micro lot at $1,000 worth. So even if you are new, you can start small and slowly scale up your position once you gain more confidence. All right, so if you're interested and want to start, you can always request for a demo on MT5 itself. So there are useful tools available, no commission, low spreads, and there are CFDs in terms of global indices and oil. Also, you can keep up to date with the news, and you can trade various products on MT5 itself. So if interested, do scan the QR code attached. All right. Also, there are video tutorials available on MT5 itself on our website. So if you're interested, you can watch them as well. If you are keen on trading but don't know how to get started, we also do provide one-to-one coaching. All right. So do drop us a call, and then we can arrange a one-to-one coaching appointment, and then we can guide you from there. Right now with COVID, even though there is COVID-19, we can still do one-to-one coaching using various online platforms. So not to worry, you do not have to go down physically to our branch. So how to partake in the Forex markets? First thing is to find a broker, all right? Second thing is to open a trading account. So brokers are people like Phillip Futures. Second, you open a trading account. Third, you download a trading platform like MT5. It's an award-winning platform. And last, you start trading from there. So if you don't actually partake in market action, you will never sort of like learn, or you will never have the confidence to make the first step as well. So to get started, you can always go to our website, whereby we have an online account opening link there, and just go through to actually open the account. So this is the account opening link. If you are interested, you can just scan and you can get started from there. All right. So with that in mind, okay, I'll take up any questions. So please feel free to drop your questions and I'll answer them accordingly. Thank you.
Okay, so the first question we have today is, what are the various resources I can reference with regards to Forex Outlook?
So with regards to Forex Outlook at Phillip Futures, we do give you various resources. First thing, using the MT5 itself, you can look at the news tab down there, and you can see what is happening with regards to the events, as well as some of the news analysis and whatnot. Also, we do have Trading Central as well as Auto Chartist to give you technical views to aid with your trading. If you are our Phillip Futures clients, you can also opt in for our analyst reports by myself and other analysts, whereby we will give you views on the market direction, etc. So if you want to be added to our reports, just drop us an email at the futures@phillip.com.sg.
All right, okay, so the second question is, will we be able to know the swap points before entering a trade for more than one day?
All right, for swap points, yes, you will be able to know. All right, so the swap points are actually updated daily at 5 p.m. If you actually 5 to 6 p.m. So if you actually go to your MT5 platform, if you do a right click on the currency pair and click specifications, you will be notified of the swap points for that night if you hold an overnight position.
All right. Okay, the next question is, if I want to trade the euro-dollar pair, should I just pay close attention to the European and the US markets only?
In a sense, yes, in a way, because if you solely want to trade the the EUR USD pair, you mainly would have to focus on those two markets, because what happens is that if, like example, the dollar strengthens, even if the euro don't weaken, you may see that the pair may actually still drop, because the dollar may strengthen faster than the euro itself. Because like stated, we are always looking at a comparison, so you have to monitor news from both sides. But if, like example, you have some time and you would like to monitor other news as well, it's also possible, because you may see maybe more trading opportunities with regard, because if you are looking at the euro, you may see more trading opportunities, euro and other pairs. For example, if you think that the euro is going to drop against the US dollar, but it's going to rise against the pound and is going to have greater strength against the pound, you may consider that currency pair as well. So I mean, as in, we always do not want to limit ourselves to the things we are able to do. If you have limited resources, then definitely just the US dollar and the EUR will suffice if you are only interested to trade that pair. But if you have more time and broaden sort of like your scope in terms of readings, etc., you definitely may be able to find better pairs in terms of trading opportunities as well.
Okay, we have a request for you to go back to the previous slide with the QR code.
Oh, this?
Yep. Okay, so the next question is, what is the impact of elections in currency?
The impact of elections in currencies, main thing to note, right, is that you would have this uncertainty, because people do not know who is going to be the next government. Why is that so? Is because the government will control the direct economic direction or the political direction the country will take. And that is why when there's an election, the currencies are affected as well. This is very much true in the US, all right? We see that recently they had the elections whereby the Republican elections per se, whereby you can see that Joe Biden faced off against Bernie Sanders, and when Joe Biden actually won, because his policies that he are looking at are more business friendly or economic friendly, you can see that the dollar tend to strengthen because of that. So why elections will affect the economy, or in terms of the country's stability and monetary policies and currencies, etc., is because of the direction that the new government actually intends to bring the country into. So definitely with a stable mandate and more political stability in the country, it will strengthen the country's financial position and currency position as well.
Okay, so the next question is, the Swiss and Sing dollar pair has recently risen up to 1,000 pips during Black Monday. Is the pair likely to fall back to 1.41 in near term after the panic?
I mean, as in, if you are looking at things like that, that definitely what goes up usually tend to come down. But that being said, we must understand the main rationale for things. All right, even though there's a sudden spike, does not mean that economic wise or in terms of sort of like projection wise is going to be sustainable. It may happen, but it may not be that drastic and can occur over a period of time as well. That being said, a lot of people are always saying that currencies move in a cycle. Why cycle is because currencies, unlike stocks, people will tend to look at the currencies will actually affect the trading ability of the country itself, because like example, import and exports, etc., they'll be based on the home currency. So if, like example, the currency is too strong, it will cause their exports to be very expensive, and because of that, people will not export their products. I mean, people will not import their products. And the same thing, if the currency weakens too drastically, the imports become very expensive for the country. So usually countries will tend to have a fine balance between it and try to stabilize the currency. So we always will note a cycle, and right now we will just have to determine which part of the cycle we are at. Yeah.
All right. Okay. So the next question is, I am trading with Philip Nova now. Can I have both Nova and MT5?
Yes, you can. Philip Nova, you will be trading is only futures. All right. If you want to trade forex per se, spot forex, definitely you can apply for an MT5 account. If you are interested, just contact your trading representative, or you can contact our general inquiries hotline, and they can assist you with that.
Okay, so the last question for today is if they have to pay to open an account with Philip Futures.
Opening an account with Philip Futures is essentially free. All right, it's just when you are after you have opened the account, you will have to fund the account to activate the account, because what happens is that if you do not activate the account, you essentially cannot trade because it runs on margin. So what happens is that for MT5, it's a US dollar based platform. So when unless you transfer in US dollars, if not, if you transfer in Sing dollars to activate the account, it will automatically be converted to US dollars. Yeah.
Okay, great. Thank you very much, Samuel, for the insightful session. We'll be sending everyone the video link to today's webinar. And if you're interested in more webinars, you can visit our website at philipfutures.com.sg/webinar to have a look at the exciting sessions we have lined up all the way until May. Yeah, that's it for today. Thank you, everyone. Stay safe and goodbye.